All right, today is Juneteenth. The markets are closed at noon, so I'm not going to be doing any trading today, but I wanted to talk about yesterday's price action. So Thursday, June 18th. Starting off, this is the first bar of the day. What I've noticed lately is that when we get an early sell-off, it's been bought pretty quickly. So if we look at the daily chart, what are we in? We're in this bull trend that is staying above the moving average. It's a small pullback bull trend. So it's not going up too aggressively at any point. But then these pullbacks are not all that large either. The most we got here was 4 days in a row, and two of them had bad closes, and it never closed below the moving average. So when we're in this kind of market, you get these early sell-offs like here that end up getting bought. So what I've been thinking about doing when we get an early sell-off like this, then probably like buy the close of this bar, risk 3 points or so, and then try to go for 10 points. And if you look back, that would have worked out quite well recently. So here's an early attempt to go lower, buy, figure stop 3 points below, probably target 10 points, so you get out here. Well, I mean, in this case, maybe if you bought here, you actually would have been able to get your 10 points, but maybe you bought here instead, then you would have gotten stopped out. But if you bought here, you'd be good, get your 10 points. Bought here, you'd be stopped out. Bought here, you'd get 10 points, and once another one here, bought here, you'd be able to get your 10 points. So there's actually been a lot of examples like that have worked out. So when you study your charts and you see that, and then you look at the daily chart and you see, yeah, the daily chart's in a bull trend, it's above the moving average. So that's how you can use the higher time frame to help give you trades on the lower time frame. So you can find that kind of stuff when you're studying your charts. So that would have worked out yesterday as well, buying the close of that bar and then just trying to get 10 points out of it. Obviously, you could have gotten even more out of it. Yesterday was a FOMC day, so here we see that 2 o'clock news, that spike in volatility. Nothing changed with the FOMC. So as expected, rates did not change, and we pretty much just went sideways after that. So I didn't have any trades after that FOMC. So after this big bear bar on the first bar, then we got 2 bull bars. Once again, within the context of what the market's been in, a bull trend. When I see this early sell-off like this, it's good to try to be looking to buy early. That's what the market often does. It often goes down quickly on the open and then reverses. That's the opening reversal. It's wanting to see, most days have ended up bullish, but if we sell off early, are we able to push the market down? And often what that leads to is the market just goes too far on the wrong side, and then it gets bought up, and then we reverse up. So after that, then a bull bar above the moving average, then a second bull bar closing above the moving average. That's a good place to buy, especially for a swing. So when you get an opening reversal, I mean, you could scalp. You could just go for like 6 points or something, but when there's the possible for the reversal, it might have a much larger swing. So you want to be able to take advantage of that larger profit. Wouldn't have any more buys through here unless it went down to a lower time frame and found like a pullback and bought that. I mean, these are okay to buy above, but the way the bars are a little large, like 7 or 8 points, you'd be buying into the overnight high, buying into the 200 moving average. So for me, I'd rather just avoid those. As the market starts to pull back, I'm thinking, is this possibly now the opening reversal? So market went down here, reverses up. Now is this possibly the opening reversal? Because we're still on the open. We're still around 1040 here. And if you look at past days, around 1040, around 11 o'clock or so, like here's 1020, that's when you start to see some potential for reversal. Once again here, we got up to this was around 10:35, 10:40, and that's when, and it actually ended up being the high of the day. So until you really leave the open, then when you start to see this, I would be thinking of possibly opening reversal and reversing into the middle of the day. So do I short here? Well, if you're going to do a swing trade, I think that's okay. So if you're going for 2, 3, 4 times your risk, and you really are trying to get out way down here, I think that's okay. If you're thinking the market might double in size, the range of the day might double in size and come down way down here, then yes, these are okay swing trades. But if we're trying to scalp, if we're trying to get just like 5 points or so, I would rather not be trying to sell into all this bullish strength. But some percentage of the time, it is going to be a big reversal down, and then so that's when swing trading would make sense. But your odds aren't high enough to try to be scalping. So market's pulling back. You started to form a wedge pattern. First push, second push, third push, and above this little bull bar, I'm not interested in buying here. It's fairly small relative to this tight bird channel we've had. Then you get another push lower that fails, and you get a bull bar here. So I'm more inclined to buy here after we've had this wedge pattern, these 3 pushes, with this being a reversal pattern at the moving average. If I'm buying here, I think you need to try to swing trade. So that would look like this, where you buy here, stop below, and you're trying to get out at least 2 times your risk, which is basically around these highs. So I think that's appropriate, right? You've had a bull trend. This might just be a pullback to the moving average, and then you're gonna get another leg up. In this case, you would have been stopped out if you did that. What about the so I'll mark that because that's an appropriate swing trade. Buying here, I wanted to buy here above this second bull bar for a scalp, but it did not go above that bar. So I'm not gonna mark that since it didn't actually trigger there. Market continues down. Now it's showing what I like to see, which is the market getting stuck below the moving average. We were above the high over the overnight highs. Now we're below it. Now we're making attempt after attempt to go higher, and we can't. And so that's, for me, that's kind of like a classic scalp situation when I started to see this. The market was going up. Now it's no longer going up. Now it can't even get above the moving average. And so when you start to see the moving average kind of holding the price down, then that's when I like to look for a short. Eventually, at some point, the bulls give up. The bulls that were buying here or through here, they give up through here. And that's what these 3 bars are. These are the give up bars. So the bar I'm going to mark for a short here is this one. So we get a bear bar, then a second bear bar closing near its low. And I like to sell below that second bar because so often you'll get one bar by itself, and then that does not work. So it's almost like kind of buying here. You know, you're just buying above a first bull bar here, and then you would have gotten stopped out. And what I wanted to do was wait for the second bull bar and then buy above, but we didn't trigger. So here, now we waited for that second bear bar, and then that's when a lot of bulls really decide to get out, and you see this big bear bar coming down to test the open of the day. So I like that short there. I think that makes a lot of sense for a scalp. You're just trying to sell, you're trying to take advantage of that rush to exit that the bulls are making. And so that's what these 3 bars are. They're rushing to exit. They're exiting down to the open of the day where they find buyers. And the market rallies up into the 2 o'clock FOMC. And then after that, no trades for me after 2 o'clock on yesterday. Something else I wanted to show you about why the market might find buyers here. We have an S pattern. And this is something I talk about in the trading course. So an S pattern, you can see the market was moving down, somewhat of a tight channel. Then we kind of had this more diagonal move down here, which is these bars. Then we had another fairly tight channel down here. So it kind of looks like an S. If I squeeze it up, it'll look more like it here. So we have fairly tight move down, then a more slanted channel, and then another tight move down. And when you make the move equidistant, so here's the first leg down, and then when it starts to break down below this middle channel, then the high of that is here, and that puts us down here. So with this measured move down around the opening price, that's two pieces of support. So confluence at this level, and then that's where it found buyers. So the bulls, they were trapped and they rushed out to get here. Then the bears themselves, they got too overextended and they were selling down into the support. So the bears were not selling down here, they were actually buying back their shorts. And then bulls saw what was happening, so then they started to buy back as well, and that pushed the market back up into the FOMC announcement. So there's all kinds of little things that you can learn like this, and you don't need to be doing something at every moment of the whole day. Just wait until the thing that you understand comes along, and then you trade with sufficient size on that, and then that's how you become a trader. So once again, today is Juneteenth, so I won't be doing any trading today. The markets are going to have lower volume, and they close at 12 at noon Eastern time. So this is all I'll be doing today. So enjoy your guys' Juneteenth. Take time spent with your family, go outside, study some charts, and then be ready for Friday. So I'll see you guys in the next video we make. Have a good Juneteenth.